The Federal Reserve's next meeting could quietly change the direction of the entire stock market, and almost nobody is talking about the most dangerous part. On June 17th, Kevin Warsh will walk into his very first Fed meeting as the new chair of the Federal Reserve. Most investors think nothing dramatic will happen because almost everyone expects interest rates to stay unchanged. But history shows markets don't crash because of the rate decision itself. They crash because of what the Fed hints at next. Welcome to WealthyKlicks. If you follow US stocks, tech companies, AI plays, or global markets, this story matters way more than people realize because trillions of dollars could react to just a few sentences from the Fed chair. Now here's where things start getting uncomfortable. Kevin Warsh is not Jerome Powell. Powell spent years carefully guiding markets with predictable signals. Warsh may do the opposite. Reports suggest he prefers giving fewer clues and keeping markets uncertain. That alone can create volatility. But the bigger issue is inflation. Official U.S. inflation recently jumped to 4.2%, the highest level in years. Energy prices exploded after tensions in the Middle East disrupted oil routes. At the same time, the U.S. economy is still adding jobs faster than expected. That creates a dangerous setup, because if inflation stays high while the economy remains strong, the Fed may delay rate cuts far longer than Wall Street hopes, and that could hit expensive growth stocks hard. Now let's get to the part many investors are ignoring. Donald Trump reportedly wanted lower interest rates and publicly pushed for cuts before this meeting even happened. That puts Kevin Warsh in a very difficult position. If he sounds too aggressive on inflation, political pressure could rise. But if he sounds too soft, markets may fear the Fed is losing independence. And historically, when investors stop trusting the Fed, things can spiral quickly. Back in the late 1970s, political pressure on the Fed helped inflation explode into double digits before emergency rate hikes shocked the economy. That memory still haunts Wall Street. Now here's the key signal investors are watching. Not the rate itself, the dot plot. That's the Fed's forecast for future rate cuts. If officials suddenly signal fewer cuts or no cuts at all for next year, bond yields could jump and high valuation tech stocks could come under pressure almost instantly. And if the Fed surprises markets with an even tougher tone, global markets could react violently, especially AI stocks, speculative tech plays, and rate-sensitive sectors. So the real question is no longer, will the Fed hold rates? The real question is the easy money era getting pushed even further away? And that answer could decide where markets go next. If you enjoy stories about market shocks, hidden financial risks, billionaire moves, and the forces quietly moving Wall Street every single day, make sure to like, follow, and subscribe to WealthyKlicks because we post stories like this daily. Thank you for watching.